Nervous about the volatility of public markets? Looking to invest in Canadian real estate but not finding the right opportunities? Neighborhood holdings may be an option. Nearly 10 years of consistent performance, Neighborhood aims to provide stable income while preserving invested capital, target net yield above 8%. At the heart of the strategy is Neighborhood's mortgage product portfolio of first position 100% residential mortgages across Canada with an average loan to value under 55%. Neighborhood partners with mortgage brokers and financial institutions who support quality borrowers in transition who may not currently qualify for traditional financing and have a temporary need for capital. Neighborhood's portfolio has no exposure to commercial, construction, or bare land properties, is geographically diversified across major urban and suburban centers in Canada. Check out the links in the description or visit neighborhoodholdings.com to view the offering memorandum for investors and advisors or to explore mortgage broker partnership opportunities. This is not advice. Please consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 204. As always, joined with the three amigos, Boomer over in Halifax, Rich Diaz in Montreal. No art wall.
No
Where
art
is it?
wall. And I'll tell you my address. No, I won't tell you my address. But I've moved down the road, which was a trying and stressful day or two. I think I did 25,000 steps, but nobody wants to know about that. What people want to know about is the art wall. And don't worry, I'm going to redo it.
Anything good?
Anything good? I don't know. Wait, what's going on? Help me.
Where are you going? Come back.
Oh, no.
Come back, Rich.
I also got a new desk.
So those who
Anyone
are
else
listening, Rich
Yeah.
has one of these fancy, smancy desks that can move up and down. Is that what?
Yeah. It's from IKEA. It's not that fancy.
And I'm still
Boomer,
old
what's
school,
going on?
Steve.
It's nighttime. We're recording on Wednesday today. That's a full disclaimer for anyone that's
Yeah.
wondering if we're a day behind what's going on.
Yeah, my hair looks more blonde. So this is a really cool week in Halifax in that it's back to school week. So all the universities are back, high schools are back, elementary school and primary and everything. I did have a challenge though. I go to my gym, which is at one of the universities, and it's just flooded with all these new people. And I'm like, who are these people? And there's one piece of equipment that's not in use.
I know what it is.
What is it?
The pull-up bar.
Yeah. That's only old guys use that, eh? I walk in, I do my thing and leave and just, drop the mic. And but the good thing about, the back to school gym thing, 2 weeks from now, they're all gone. But my favorite, I don't know if I mentioned this before though, Steve, but my favorite scene in Halifax in early September, in like back to school, you always get like two college kids, they're walking on the road carrying a Chesterfield or sofa, whatever you want to call it. They'll have a case of beer in the middle and they stop every block or two and sit down and have a beer and then they keep going.
I love that you just called it a Chesterfield. That is
a Chesterfield. I think that's a British brand from
That's
years
old
ago
school.
or something. Did you call it that?
no,
Chesterfield?
never did.
Rich?
I've played Chesterfield rugby. Never
So
mind.
Steve, I noticed you have no art behind your wall tonight. Yours is different as well.
Yeah, I'm at home because our timelines are all messed up. But episode 204, lots to talk about this week. Last week on Friday, we had the Canada GDP numbers that came out. So we'll kind of walk through that. Some updates on our population growth, foreign students, foreign workers, pretty much like all things that we've been talking about for a couple of years now. So we have some important updates on that. I think we got lots happening. Keith, you talked about it kind of last week. You're like, wait till September rolls around and markets are going to really liven up. And I think we're seeing that really playing out in sovereign debt markets. Gold is telling us that as well. So we'll kind of walk through all of that this week. But Rich, you've been following the Canada GDP story. I think you put out a video
Yep.
on it as well on the Ice Cap channel. But maybe walk us through that. I think Q2 GDP annualized negative 1.6%. What do you kind of take away from that headline?
So, I mean, it's a stunningly bad headline. I think there's no real way to sugarcoat that. GDP shrank at a 1.6% annualized quarter-on-quarter pace. Well, a bit of a mouthful. And this, reversing the 2% gain in Q1. Sorry, and just to add to that, it was driven by exports. I'm not sure if we talked about it last week or not. Certainly, if you follow me on Twitter, I published all the charts where you can see the biggest drop in Q2. Sorry, the biggest drop in exports was Q2 of 2025. But I actually think the GDP number wasn't that bad. I know, I got to avoid all the tomatoes as they get thrown from the back. If you look at, so obviously the exports were horrible. And sorry, let me rewind. Just so people understand, the expenditure approach to GDP is basically consumption, government spending, investment, net exports, and then a inventory component. And so, obviously the exports were a disaster. Imports didn't fall as much, so that's a huge drag on GDP. And then as a function of that, you had obviously a big drag from business investment. People are worried about tariffs, and so they're not going to invest as much. But if you actually look at the data, we got a relatively decent size contribution from government. I know Keith doesn't like that, so fine, let's park that. But the part that really surprised me was spending and residential investment, which was really strong, 2.8%. And so I'm of the view that actually we should probably get a recovery in those numbers into Q3. I can't believe I'm saying that, but
You just call the bottom?
No.
Call the bottom.
No, I'm not calling the bottom, but I just think, let's just hold out. Let's just hold out judgment, because I think the snap reaction is like, oh, we're in a recession. First of all, we've been in a per capita recession for at least 3 years. So the recession conversation, I think, is bogus. I think what's really interesting is how well household consumption has held up and how well investment has held up.
So I feel like, it is nighttime, of course, recording this on a Wednesday night. I feel like it's the Twilight Zone. Like, what the heck are you saying, Rich?
I'm saying it's not as bad as I think the headline.
Where did, household consumption?
Yep.
Has debt growth increased as well at the same time?
No, that's been relatively flat, certainly as a percent of GDP.
So I have not spent a lot of time on the number because that's what Rich is doing for us. But overall, it just seems the direction went where it should be going. But you are suggesting that maybe it wasn't as bad is what the headline number is.
Yeah, I mean that's our job, right? Our job is to play it straight. And I just think, the tariff stuff, it could be a one-off. We'll see how it plays out in Q3. A lot of the, it might get worse, it might get better, but I think that 60 something percent of Canada's economy is what's it called? Is consumption. Obviously, big chunk is government, so that's held up.
I think those well though, Rich. I think didn't Q1 have a big positive impact because of like inventory accumulation and everything,
right?
Because of the tariffs. So that would have implied that Q2 would have been, negative, of course. So I think, the overriding theme from this, as the scars and the sensitivity from the tariff wars, for example, whatever you want to call it, that is starting to peter out. So it's starting to soften. So maybe in the second half of the year, we get better data for what's actually happening. So whereas Q1, what was the number for Q1? I don't know.
I got it right here. Sorry, I had it right. 1 second.
Dun,
So Q1
Steve.
was +2.
Drum roll.
Plus 2.0. Q2 was negative 1.6. I'm just saying, let's let the trade war shake out. It's transitory.
So as we go to Q3, we'll really figure out which direction we're going with it.
Right.
Steve, do you have thoughts on it as well, Steve?
I mean, I think just slow growth. I think we had Rich, payrolls last week. So private sector payrolls private sector payrolls are negative on an annual basis. So in the past 25 years, it's only happened on 2 other occasions, '08, '09, and the pandemic of 2020. So I think that, National Bank had a great chart out as well last week showing that basically there's hardly any sectors that are actually expanding right now in terms of hiring. So I just think when you look at all, you can kind of like weed through the numbers. You can try to find little tidbits here and there, but I think ultimately the trend is, as Keith likes to highlight, is the trend is weaker growth, softer labor markets, and that kind of cues up the Bank of Canada on deck. What, Rich, 2 weeks from now?
Yeah, I mean, I don't disagree with any of that. I'm not saying that Canada, like it's all, it's just candy canes and lollipop. But what I'm just saying is there was a lot of emphasis on the negative GDP number, but that includes a massive decline specifically related to the exports. And I would like to see that export component normalize before we call it a full-on recession. Again, with the proviso that I think we've been in recession for 3 years, right, on a per capita basis. But just when it comes to that technical definition, I'd like to wait.
Okay, so Rich is calling a bottom in the economy. Steve called a bottom in the housing market. And I don't know what I'm calling yet. We'll see here.
Well, we had so I don't know if you guys, I mean, this kind of leads into the next sort of conversation, but it's all tied in, right? It's all correlated. Population growth in at least in BC and Ontario is now running at record lows through the first half this year. So you take sort of January through June, which is the data that we have available. Population growth is running at record lows through the first half of this year.
Yeah, I think I'm surprised, to be honest with you, that it snapped back. But I mean, the reality is that the legacy issues. I think it's like a good first step. And I wonder if actually it's going to shrink. It'll be really interesting if it shrinks.
So there's still a bit of growth. Like if you look at, like, you strip out BC, Ontario, there's effectively like zero growth.
Yeah.
If you look at the rest of the Canada, it's still showing, I think, about 75,000 roughly in that number. So I guess there's a little bit of growth, but again, even that has come down from, a peak of nearly 250,000 people, just about a year and a half ago.
What I think that hides, though, is the interprovincial migration. So, right. So we talked about this, I think, maybe a month ago, where we have Canada's net interprovincial migration. So BC, so Ontario and BC have negative or declining population growth, but that's partly a function of people literally just leaving BC and going to a different part of Canada. It's not just like the overall Canadian population, because year on year, Canada's population growth is still 510,000 year on year. So
yeah, I think Alberta is absorbing most of that interprovincial growth.
That's right.
Still.
So is that Red Deer? Are they all going to Red Deer? Was that
Rick from Red Deer?
Red Deer. So, okay. So, I mean, that's from an aggregate perspective. If population growth is slowing, I mean, it sort of aligns with the same trends that we're looking at. And what's positive, of course, is that, the government did say, hey, we're going to slow this down. We're going to try to, and so it seems on the face of it, that is where they're going. That's a positive.
That's my point. But that's my point about the consumption remember I was mentioning GDP, the consumption part, the household consumption part, and residential investment was positive. And, that's the view that, and so remember, so population growth has declined significantly, but consumption actually held up relatively well. And so in a world where we're having less employment and higher unemployment rates. So I'm just saying, that's why I think that, so, the instinct is to say, oh, it's a disaster from GDP growth. But if we add up a couple of those pieces, I don't think it's as bad as I think that the instinct and the headlines we're talking about. We'll see, of course, what happens. And I don't think it changes the overall direction. We're going to continue to slide into a weak growth recessionary environment. And that'll bring us to the BOC's great cut.
So I take the under on that.
Okay, go ahead.
Well, I think that,
on the BOC?
No, I think we're all leaning in sort of that direction. I think last meeting, I think Steve, you and I were, on the cut side. I think that's what happened with it. I know I was for the last meeting.
I'm trying to remember, to be honest.
Maybe Rich was you and I don't remember. but it seems like, we're just a little bit early. That's where we're going with it.
Yeah.
But if if the aggregate population growth is slowing, if that's happening, and we know job creation is, I assume it's flat to negative on an
Yep.
aggregate level. If if household consumption is still strong, in my mind, it has to be from debt.
I think you're probably right. I'll have to dig it
Yeah,
up.
do you know what I mean? I mean, with this data,
No, of course.
ex ante, it's going to be a bit delayed, of course, but like something doesn't make sense here. So if the household and consumer, if they're still positive, and this is from an aggregate level, like they're not
Yeah, no,
including
I think you're
individual
right.
households, it just means that, maybe it's more of a balance sheet side with debt coming on. So, I mean, the point is we'll get more data coming up, whether to confirm what I'm thinking, or it's going to say, yeah, we did hit a bottom. I don't think a bottom has been reached, though.
No, not
I'm
at all.
hearing
And the other
at
thing you
this
didn't
stage.
mention is that we also got the productivity data, which was negative.
Rich, have you ever looked at productivity before?
It's the only thing that freaking matters, by the way. But anyways,
well, let's walk that through. So yeah, you've got sort of contracting economic growth, negative GDP. You've got population growth growing at zero. You got private sector payrolls not growing. I mean, I guess again, waiting for the technical sort of PhDs to come out and tell us that we're in a recession, but I think for many Canadians it feels recessionary.
yeah,
And it's probably likely that we're already in one.
yeah, for sure.
So I chat with a lot of small business owners across the country, and most are telling us that it's grinding tighter and tighter. Like and again, that's the same trend we're going on. I had one family share with me just a few days ago. There's, the industry they're in, everyone's bidding on contracts. And, they told me, said, hey, like other companies are winning contracts, but because they know the business so well, they know that they're bidding at it at a loss.
Okay. Interesting.
They're just trying to slow the loss, slow the flow, so to speak. So I'm getting that from a bottom up perspective. So it's interesting, we get to reconcile, the top and the bottom and all that. So of course, this is leading to the humongous month of September for central banks. We'll go into that coming up soon.
Yeah, but I mean, yeah, just looking at the again, I'm kind of curious now, like as this all plays out, right? So if you're kind of like tiptoeing into this recession, we know the Carney government's like, listen, we're going to run these massive budget deficits. I'm kind of wondering where do you go now?
Don't release the budget. Do not release it.
Don't release it.
That's a danger zone. Don't do it. Hold it back.
If a budget never is released, is it really negative? Mm-hmm.
There you go. Science. But I'm wondering if like something's got to give here, because we're being told that, listen, we're going to continue to sort of choke population growth. Like you've been so reliant on just bringing in people to drive, the nominal number higher, that you've got now you've got no growth. You milked every last bit of milk you could out of the real estate sector. That's completely toast. And all your businesses that rely on foreign workers, we're told that might need to be slowed back. I don't know. Just I'm wondering as a policymaker, like, where do you go from here? I mean, like, do you try to like re-stimulate population growth, housing? Do you just eat your medicine? I mean, you can't, Rich. I think we all agree that you need to invest in our energy sector, critical minerals, but I mean, that is not like an immediate return. So
No, of course not.
I'm kind of curious just from a political perspective. We know what they should be doing, but I'm also like, well, there's an election cycle every 4 years.
They're gonna stick their head between their legs and they're gonna kiss their ass goodbye. I mean, there's nothing they can do really. I think that's this is the thing. I think they're not.
So what else would you say to your ass if you're able to do that? Is that why you're going to say goodbye? Why not hello?
Nobody from the government wants to level with Canadians. And that's what maybe we can do on this podcast. It's going to get worse, folks. unemployment is going to rise, GDP is going to contract 2 quarters in a row. It's completely politically impossible for them to raise population growth, especially with today's announcement. And we know we're not supposed to talk about politics, but the pressure on growing to cut the temporary foreign workers, they can't revitalize the investment piece without changing all these rules. So yeah, I think we're in for it. I think that's the bottom line. I think there's no real way to sugarcoat it.
It's interesting to see like the pushback though on all the population growth, and now it's like the foreign students, the foreign workers. So again, keep in mind the federal government, sort of like Trudeau's last sort of parting service, was effective that we were going to finally put a stop to the whole foreign student program. It's kind of funny. I was reading an article in the CBC just last week where it's like, okay, now that you've cut all that back, it says layoffs pile up at BC schools, creating, quote, the biggest crisis in post-secondary ever, says the Faculty Association. And they will go on to say, this is a real frustration. It hasn't been recognized as such. What is going to replace the international student income, which colleges have depended on? So, like, nobody wants to eat the medicine. We're eating the medicine now, and everybody's complaining. Everyone's putting their hands up. The foreign workers, you had the Polyev came out today or yesterday saying that, he's proposing to put an end to the foreign worker program, the temporary foreign worker program, which has been heavily abused in Canada. And so, it was funny. And then Carney came on the same day and he's like, well, when I travel across Canada and I talk to all these businesses, the first problem they say, the number one problem these businesses are facing is the tariff stuff. The number two problem they're facing is the ability to retain and attract foreign workers, which is wild, right? So it's like you literally just admitted everything that we've been talking about, which is, okay, we've become dependent on foreign students and foreign workers to derive effectively cheap labor and nominal GDP growth.
Yeah.
I mean, Steve, what do you say sometimes,
Steve? It's all crumbling down.
Sometimes you go like, oof, or oof, or what is the oof? But it's the point, like, so what's Canada's, like, I'll often, like in the business world, I'm chatting with someone, I'll often say, hey, what's your competitive advantage? Which really takes a lot of people, they're like, whoa, I never thought of that before. And if you don't have one, then that's fine, but you should recognize that at least. So what is Canada's competitive advantage? Importing foreign people? Is that it? Like, we import more than other countries? If that's what it is, oof. Is that what you say, Steve? Oof. Yeah. Oof. This is not the solution, right? So for universities, for example, like down here, and again, University World in Halifax, the Dalhousie campus professors, the faculty, they're on strike. Their slogan is invest in people, not buildings, which I don't understand that really, because it's, it's different ways money is allocated. But if the whole business model for and it is for university, and by the way, there was a very kind contributor, someone who reached out to us, said, hey, they suggested someone we speak to about the university world, which I think we will follow up on. But that business model, it's over now. Like, it's broken. So we have to move to something different. So if the university model is broken, it implies that the rest of anyone in Canada who's reliant upon, foreign workers coming in to replace local guys, who assume, guys, it's a cheaper version of the worker.
Of course,
is that right, Rich?
Yeah, of course, not doing it out of the goodness of their own heart.
So how is that a competitive advantage? I don't think it's not something that's sustainable. So again, and like my view on all this stuff is that, governments and the big banks, they think of the world like this constant, like, you get a cycle moving like that. But to move beyond, I think, Rick, you told me today, like the first or second standard deviation band. Yeah, like, that's not even in the thought process. But that's where we're going. Yeah. That's what the mindset has to be here.
Yeah, like it's
And,
going to
you
be
know,
significantly different. Sorry, go ahead. Sorry.
yeah, and, you know, unfortunately or fortunately, depending on which way you want to see this stuff, you know, the country's not ready for it, nor are the Europeans ready for it. Well, especially the Europeans, because they're pretty fluffy with everything. But that's where we're going, Steve. Like it continues in that direction.
It just reminds me of a Warren Buffett quote, which is only when the tide goes out do you learn who's been swimming naked. And these universities have been swimming naked, right? It was a fake model and it's being exposed. And I think just from a political standpoint, I know we're not supposed to do this, but I have to. What's fascinating is like, you know, Bernie Sanders in 2014 said that like these open borders, like inviting all these types of people was like this right-wing conspiracy to destroy the labor market. That's what he said in 2014. You can Google it. It was an interview with Ezra Klein, who's a really interesting writer. And it's amazing how after all these years, like Bernie was right. And when you hear Mark Carney talk about how all these corporations are desperate for these, you know, foreign workers, it proves that Bernie Sanders was right. And that is what these corporations have been sort of geared their entire business to. It's what Steve actually said a couple of months ago. And it's about undercutting the labor class with foreign workers. I mean, that's the bottom line. And I hope that politically it's now seen as completely non-sustainable.
Well, the Europeans, by the way, they don't use the word naked. They use the word textile free. Apparently, that's the.
Yeah, Rich, I think we should add there's like an asterisk in there, which is to say
Sure.
like Canada obviously needs some foreign workers,
Yes, of
particularly in like the agriculture sector where we've had, you know, guests on to come explain sort of that industry. But there's a lot of jobs out there. There's a website. I can't remember what it's called, but it was on Twitter there. There's a new website where they're basically posting all these temporary foreign worker like
it's called LinkedIn.
no. It's like they're basically posting all like the scam jobs where basically like it's like, oh, $36 an hour to be a Subway sandwich manager, and they can't find a local Canadian to do the job, so they need a temporary foreign worker. It's like you're telling me with like youth unemployment at like multi-decade highs, you can't find someone for $35 to manage a Subway sandwich.
Yeah, I mean, also just so people understand, there's a carve out for agriculture. So when people say like, oh, we should ban the temporary foreign workers, and people are like, oh, well, who's going to pick our strawberries in Quebec or whatever? There has been always, and there would be a carve out for the agricultural sector, which is strictly seasonal, which really is temporary, and you know, etc. Sorry, little.
No, I mean, I think
addendum
that's
to that.
good.
So it's
Yeah.
not a clear-cut response then. Like it's not all or nothing,
Right.
clearly, but we're just pointing out that the growth that Canada has experienced over the last number of years, it has been because of this higher than normal population growth, and it's affected all of our industries, all of our sectors, and so forth. Now we're moving away from that. You know, what was it, Rich? Probably 9 standard deviations for population growth,
I mean, I've shared that it was at least 3.
or
Right.
9 maybe. Like it was big.
No, it wasn't 9. It wasn't 9, but it was a lot.
But the point is, we're now coming back, and you know that has a bit of payback with it.
Same thing. So same thing, obviously on housing, right? How much of the housing demand was from zero interest rate policy and 9 standard deviation immigration? I'll give you like a good stat that just came out from our friend of the show, Ben Rabideau. So the total home sales year to date for pre-construction new home sales in Toronto. So new home sales year to date, we're at 2,600 new home sales January through July.
Yikes.
That's down from about 26,000 in 2022. So we went from 26,000 to 26. We sold 2,600 homes in a metro region of nearly 7 million people.
That's
so like
wild.
You've basically choked off one of the largest revenue income streams. So not only have like, you know, again, I just look at all the fake colleges and universities that have been deriving all this revenue and tax profits for the government, and the real estate sector, all of this has been kind of built up on this like mountain of sand. And it's all just kind of crumbling underneath us. And now we're like, okay, well, we got to do something. We got to do something quick.
There's no quick fix to this, dude. That's the point. People want a quick fix. People want Mark Carney to save our souls and blah blah. You don't have years of buildup and then in an instant have it all be repaired. And I think that's the shitty thing that we need. Sorry, we're so negative. Maybe because it's dark outside, but you know what I mean? Like that's just, there is no quick fix.
Well, I think the optimistic side of this is that because we did have 40 years of, rates always going lower and at zero. So the optimism with this, I think that people and families, households, and businesses, if you're able to recognize it, you don't have to get harmed or damaged as much as what's potentially could happen.
Yeah.
And whenever there's a crisis, I know a lot of people in different industries where it's like dog eat dog all the time. People are always dropping out of the industry and everything. And if you hang around there and you always survive, whenever you have one of these, moments or experiences which are not very nice, I continue to think that's where we're headed. Those who are still around at the time with liquidity, oh my God, like you're going to make multiples on your balance sheet, on your bank account when it's done. And you have to admit, like, how many people watch the Loonie Hour, follow it? 500
million.
people, maybe.
A million.
Well, yeah, maybe not a million.
Rich's mom.
Rich's mom.
There's at least 2 people.
His 8 million cousins in Portugal.
Yeah, that's right.
Stuff like that. But my point is that with anything like the way the world works, like it's not the majority, it's 90% plus always have their head in the sand. Like they have no idea. They believe, especially in Canada, you believe your government. Whatever your government tells you, it is true. It's the fact. I think you actually ever met government and you had a serious conversation with the people making decisions, you would walk away and say, oh my God, I have to move. Like the skill set is maybe not quite as strong. If someone is the minister of, like, for example, if you're the minister of immigration and then a minister, you go down that road, of course, you realize, wow, like it is kind of thin there. So my point is that we can have this moment, but people who are prepped for it and companies, man, you have a great opportunity coming up here. It's not something to be frightful of. It's something to embrace. So how's that for the positive comments?
Yeah, I'll give you
love it.
Yeah, I'll give you another. I'll give you another positive. Bloomberg article today. Alberta oil output hits record in July as well production surges. So Alberta's oil production rose to a record 4.32 million barrels a day in July. There you go, Rich. There's your turnaround.
Yeah, well, we're going to sell some stuff to Germany. No, I'm teasing. I think it's great. I think that Canada has an incredible opportunity basically to exploit its natural resources in an ethical and sensible way. And it's just something we've talked about for a long time. So
I think we're seeing that the rhetoric though is changing.
Yeah, for sure.
Right. Which is as much as we like to bash on government and this and that, I think Energy Minister Hodgson there was had a really good interview clip. I think was it a German interviewee that asked him about that?
Yeah, I think so. It was amazing. Go carry on.
Well, yeah, I mean, effectively, you correct me if I'm wrong here, but the gist of the question basically, so there's been a pact. How much that's worth, we do not know. There's been a pact signed that says German is interested in Canadian LNG. So now apparently there is a business case. So we are apparently going to sell them LNG. And so
I think you meant to say there's now a government case.
Yeah, the government has decided that there is in fact a case. So they're going to sell them some LNG, and the reporter basically asked, "Oh, well, Germany is supposed to be transitioning to, remove fossil fuels. Doesn't this sort of impact all of our goals and ambitions, not only for Germany but for Canada?" And Rich, effectively, his answer was like, This is you're an idiot.
No, that's credit to Tim Hodgson. I'm sorry, I'm teasing, but that's credit to the. Sorry, please.
Yeah, he kind of railed against the guy, which is like, listen, like the math is the math, which is like you're gonna need this fuel and you're gonna need it for a long time, and Canada effectively sources this ethically and responsibly, probably more than any other country in the world. So if you're gonna import LNG because you need it, you may as well import it from us. Was effectively his message.
Yeah, and so he nailed three things. One is what you just said, which is you might as well import it from us. Two, he said natural gas is less carbon dense or produces less emissions than coal. Duh. And three, which he said is a huge opportunity for the Indigenous population of Canada, which are spearheading a bunch of these projects. Also true. I mean, basically what he was saying felt so refreshing and clear-eyed because we've been stuck with our head up our bums for so long. You know what I mean? Like, sorry to use that reference again, but you know what I mean? Like, it was amazing. And
did he change the emissions cap? Has he come out and said that?
No, he did not change the emission cap.
It's called gaslighting. I'm not convinced, guys.
You're not convinced?
That's until they do that, then you'll see the business case come through.
I mean,
Keith, I'm one step at a time.
That. I know you're skeptical at it. I get it. You know, the things you're talking about are Bill C48, the emissions cap, and Bill C69, among others, the Impact Assessment Act. I'm just pointing out, and I think Steve's pointing out, at least finally, the rhetoric from the bully pulpit is not. What did the previous minister say? That the global, sorry, it's so ridiculous I can't even get it out. Crude oil demand is going to peak in 2024, or that there's no business. I mean, at least we're moving in the right direction. That's all I want. I think Steve was pointing out.
So who said that? Was it crude oil consumption or production was going to peak in 24?
You can Google this. Jonathan Wilkinson, the Honorable Jonathan Wilkinson, who was the previous energy minister, said that global crude oil consumption was going to peak this year, which he was talking about 2024, or even this decade. I mean, which is absurd, like categorically almost borderline insane thing for him to say.
And has it? Like, is the number?
No, of course not. No. It's 104
So where would you
million.
get that from? What would drive that? Like, where do you get data? Who is providing them with strategies or policy?
The IEA, Rich?
Yeah. So the IEA, which is the International Energy Agency, is a think tank, I guess, or global I don't know what they are. Anyway, I don't know what they're technically. A non-governmental organization that does a lot of really good work on energy. You know, in the 70s and 80s and 90s, they used to do lots of amazing work on oil and gas and whatever. And then at one point, they just completely went. I was going to say something from my favorite movie, Tropic Thunder, but I won't say. They went completely, totally crazy. And now they basically, all they do is pump renewable energy. And it's a real shame because there's some really smart people who work there. And what they do is they create forecasts. And every year they'll create a forecast for like 10-year forecast, a 5-year, 10-year, whatever forecast for all the oil and gas. And for the last basically 10 years, every single forecast that they've ever made has needed to be revised up because it's no longer a entity that tries to provide hard-hitting research. It's become a political action committee, basically.
Yeah, because I'm being negative tonight for whatever reason. Is that the dark sky and way past my bedtime, Steve. By the way, very late for me. But like, who do you get paid? Like, how do they get paid? Where did the money come from? And I think if you follow those lines for anything, whether it's something you agree with or disagree with, then it becomes a bit. So what else we got, guys? Like,
I think so much of that demand, though, Keith, is obviously now becoming about the data centers, the usage of AI. I know I found it interesting that the CEO of Coinbase, for example, was showing that. Their daily code written at Coinbase, how much of that is now AI generated? They've gone from roughly 20% at the start of the year to over 40%, and they're going to get that to 50% by the end of this year. So just like seeing all these like massive corporations and obviously the demand for power that we've talked about at length on the show. But
Well, I mean, did you hear? That reminds me of like what did you see? Oracle, which is Oracle's a big U.S. Tech company. Sort of, I would call it old tech. So it was around in the '90s. You know, it's been around probably 50 years or whatever, but it was around in the '90s. It would participate in the dot-com bubble, and obviously they've done really, really well because they're sort of back end system. I'm out of my depth here, but I do know that they announced massive layoffs. Like 20% of their workforce, I think, is going to be cut, which is enormous. So it's all related.
Kind of scary. Which, Rich, I mean, speaking of job losses, we also had the U.S. Job openings data that came out.
Yeah.
Anything that you took away from that?
I mean, what's quite remarkable is there's still 7 million jobs that are open, and I think only 6 million people unemployed in America. I think, if I'm not mistaken, those two numbers are quite next to each other, so it's kind of ironic. I just a little bit. That's what we call frictional unemployment, by the way, if you want to be a nerd about it. But what I think is, I think what's interesting is that it's obviously low. It's well off the highs of something like 11 or 12.
Rich, it was 11. It was about it actually was 12 million in the basically the peak of 2022, right? When every market was ripping. But March of 2022, 12 million job openings.
Yeah. So now we're back to 7.1 or whatever it is, 7.2. But I think listen, the takeaway is that we're moving in the same direction. I think we got something wrong with respect to the United States. Had you asked us a year ago, you know, if we thought the U.S. or excuse me, I shouldn't speak for you guys. If you had asked me a year ago if I thought the U.S. was going to enter a recession, I would have said for sure. Parts of the economy, I would argue, are in recession. We know the manufacturing ISM PMI is 6 months below 50. That's 6 months in contraction territory. If you look at the National Association of Home Builders, there's a really important index that's as low as it was during the pandemic, which is kind of wild if you think about how crazy that is. Housing construction is a big, big business in the United States with loads of knock-on effects. That's really, really negative. But, you know, if you look at the job openings, 7.1 million, sure, it sounds like it's collapsed, but it's basically what it was in July of 2019. Or, you know, and so I guess I was definitely wrong. I was way too negative on the U.S. economy, which is actually, even though there's loads and loads of little indicators that are telling you flashing red that things are going badly, it seems to be hanging in there.
Well, I mean,
I guess
the U.S. is a very dynamic economy. Of course, there's always lots of things moving around. We mentioned before we're doing this Wednesday night, but Friday is the first Friday of the month. Steve, what happens the first Friday of the month in the U.S.?
Non-farm payrolls.
Baby, you didn't say baby. Do it again. Say it again.
Non-farm payrolls, baby.
There you go. See, it's excitement. The reason there's excitement, though, because there's two data points every month that moves the market more than anything. That's the non-farm payroll number and the inflation print that comes out. And just remind everyone, you know, last month we had the American jobs data, and it was, you know, it was a bit wacky. And then we had someone lost their job, and we had the revisions and all that stuff going on. You know, that's a bit cryptic. If people are not aware, the Americans revised their monthly non-farm payroll number to show significant job losses over the last, was it just 1 year, Rich, or a longer period?
Yeah, I can't remember. It was a lot. That was like almost 1 million jobs were like they.
So it was a pretty big deal. It was a bit of a shocker, you know, for markets and for policy and everything. The person in charge of, you know, signing off on the jobs data, you know, lost their job and stuff. So now we get the new number coming out right now. And I think now usually the American job number estimates they're pretty close to what it's going to be. That's why if it's off from estimates, it's a big deal. Unlike the Canadian number, you know, it's Steve's favorite, you know,
random number generator.
Yeah, the random number generator, man. Baby, there you go. I think this Friday will be the random number generator. I think it's whatever comes out, it's going to be shocking, which of course lays the ground because, you know, the White House, they want the Fed to cut rates, especially the Treasury Department. And Rich, why does the Treasury Department in the U.S. want the Fed to cut rates?
Because they want to issue lots of short-term bonds to fund the deficit.
Yeah, absolutely. And the same thing is happening in Canada. So this month, I think is it ECB next week?
Yeah, the 9th, I believe.
So the ECB, so everyone is meeting this week, all the major central
No, 11th.
banks.
Sorry. It's Chile. Sorry.
Yeah, it's a bit, their number's a bit cool. We'll see what it is. But for everyone else, it's looking like everyone is going to cut this month.
Yeah,
So
what's even the BOC, Rich, probabilities have turned up
Oh
to
yeah,
what,
so that's really
60%?
important. Yeah, so it's amazing. 3 weeks ago, the probability of no cut was 70%. Then we got that data point, we got the inflation print, and then we got the labor market print. And then so that in 1 week, basically we dropped 10 points to like 60% no cut. And now as I look at it, we're at 60% cut. If that, yeah, that makes sense. Yeah.
So
it's
we have a
amazing.
live meeting coming up. Next
Yeah.
week will be a major Twinkie bet week, I guess, for us.
69%. Wow. In the by the way, in the half an hour we've been talking, it's jumped up another 5 points. You have to take that with a grain of salt, but it is interesting how it moved.
Steve, you're a market mover, baby.
Yeah, you're more market. But wait a second, Keith. Wait, it doesn't make sense. So Mr. President Trump wants employment to be good, but if employment's really strong, then obviously the Fed won't cut. But he wants, so he wants the cut, and he wants strong employment. I don't know.
It's kind of like, a Nirvana kind
of course
world. We'll see. That's where we are.
But
I think though, but again, the main point here right now, we started the year, everyone was cutting, cut baby, cut, except the Americans, they weren't cutting. And then we moved on to, oh wow, now the Americans are going to have to cut aggressively. So the rate differential is starting to converge, right? They're going closer together. Mm-hmm. They're getting closer. And now all of a sudden, everyone else is going to start to cut again. So the rate differential is no longer negative for the US dollar. So we'll see, when we get everything going here. But I think, I think everyone except the Japanese cut rates, and Chile. I don't know what Chile's going to do. But
Keith, you're talking
all the
about
major banks can cut rates, except Japan.
You're talking about something really important, which is the expectations. We always talk about like expectations versus what's priced in and how that moves. And so people say, people say, Keith, if they're going to cut rates, shouldn't the dollar then react to that? And just want to be clear that all of those rate cuts have been priced into what we call as the Fed fund futures market. So just like Canada has an OIS curve, which has been moving rapidly as cuts get priced in again. So the US has what's called as a Fed funds curve. And all that stuff was priced in 6 months ago, basically, so that's why.
Just think how excited Steve's going to be if the Bank of Canada cuts rates.
I'm more excited about the Bank of Chile.
What's happening to the long end? That's what I want to know.
Well, yeah. So that was kind of my next segue, which was to say that, so the anticipation again is all these central banks are coming up for apparent rate cuts in the next couple of weeks. And Keith, the bond markets have an opinion of their own. What are you seeing there?
So we have this very unusual experience now, Steve, where so on a yield curve, the short end is, the Bank of Canada rate, think of it that way. And as we just said, the Canadians, the Americans, the Brits, the fluffy Europeans, they're going to cut rates. But long-term rates, I think like the 5-year mortgage or a 10-year mortgage, to sort of think of it in that way, that's starting to rise around the world. And normally when you have a steepening yield curve, that suggests that your economy is doing well.
Whoa.
But this, that's what would happen. But usually when you have an inverted yield curve, Rich, and that's when it's signaling something different. But investors are increasingly becoming more nervous about long-term rates than short-term rates. And at the same time, gold is hitting new highs all the time. Equity markets are hanging out in that area. And again, like we do live in an imperfect world that we're discussing all the time. But a lot of these different data points and market points and metrics, they are all suggesting something very odd is happening. And we'll get a, I think Rich will agree as well. We're getting something will get something is it's going to cleanse itself, at some point. Now, is that a year from now or 2 weeks? We don't know. But if all of a sudden you get all central banks have stopped cutting and one is going to cut and now they're all back to cutting again at the exact same time, we're seeing like IMF stories for the Brits and the French. I mean, and then like Labor Day is over, as Rich said earlier. That like this is exciting times in our world anyway.
Yeah, I think you're being way too. Maybe it's because it's past your bedtime, but Keith, the 30-year bond yields are ripping in Europe, and that, I mean, yeah, you're being way too soft. That has been the big news on the street, in the news wire, on Twitter this week.
I didn't want to scare too many people, Rich. Why don't you?
Well, I
I've
just
been
think
accused of being like that, so you go. You do
okay.
that.
Well, I just think it's. I mean, first of all, it's I chalk another one up for the Loonie Hour. I mean, not that we should brag too much because we get enough stuff wrong, but the long end of the yield curve, the 30-year, especially in the UK, has basically hit a 27 or 28-year high, and that is a remarkable sort of indictment on what's going on there. Now, we're not exactly sure. It's basically a buyer's strike. I mean, in the 80s, Keith, right, there was something called bond vigilantes, which is people who basically were disagreed with the monetary policy of central banks and basically tried to put a lot of pressure either by shorting or going long or whatever different bond instruments. And I think we're seeing the resurgence of that. I think people are not buying those bonds, and why is that related to the bond yield? So remember, bond prices go down, yields go up, and bond price, just like a stock or a house or car or whatever, if more people want to buy that, there's more demand than supply, it pushes up the price. And if you push up a bond price, then the yield on that instrument will fall, and vice versa. If the bond price falls, then the yield is going up. And what we're seeing is the 30-year bond yield in the UK hit 5.69. In the US, it's 4.97. I think we cracked 5.00 today, which is a huge sort of psychological level. In Canada is not immune to this. We're at 390 in France and Europe, whatever. And what that's telling you is that the long-term paper is basically no one wants to buy it. I mean, not no one, excuse me, but you know what I mean? There's a lot fewer buyers than there are sellers. And I think this is just fascinating. That this is, to me, like the most interesting thing this week that's been happening. And again, everybody always talks about the stock market, and no one talks about the bond market. But as we've said many times, or Keith has said many times before, the bond market is way bigger and more important than the stock market.
I mean, that's a good point. I mean, we're going to go into this. I think we'll maybe on a different platform or venue, we'll have a pretty good discussion on it coming up. But
70% bonds.
That's not going to end well, man. But you have to, like, as an example, let's just say the French went into their, like, oh mon dieu. Is that right? Is that good, Rich?
That was pretty good,
Yeah.
actually.
Yeah. Oh mon dieu, yeah.
Oh mon dieu. Yeah? No? Okay.
Yeah.
But
Sorry, I just read a headline that was crazy.
So then you look though, like who owns French government bonds, right? Besides pension plans, you look at the banks in France. So if the French government runs into a problem, and I think it's September 8th is coming up, they have their non-confidence vote. And by the way, the vote about that is going to go something like, hey, we need to stop spending as much money as we're doing, or we're going to collapse. And that means less Social Security spending. The opposition parties are going to say, whatever you say we should do, we're going to vote against. Right? We don't care. So it's going to go down that road, of course, whether they do or they don't. Think who owns? No, French government bonds, and all the French banks do. You might be surprised. Guess who else holds French government bonds? It rhymes
Canadian
with
banks.
Manada. Yeah, Canada. Yeah, absolutely. Yeah, they all hold this stuff, right? Not at the same degree as the French banks, of course,
No, of course not.
but they absolutely have it. Then you start going, okay, who holds banks issue debt? They issue paper. Who owns the French bank paper? And you start connecting the dots. Who owns, British government bonds, the banks? And you start going here. So when we talk about, these interesting events that are happening outside of Canada. And maybe some people saying, oh, it doesn't matter. The French economy represents 0.35% of the Canadian GDP. Man, you've been gaslit on it. It doesn't matter. It's the balance sheet side, is the debt side. So if there is some kind of a liquidity, credit, bond market crisis in Europe, is it going to hit Canada? Absolutely. It's guaranteed to happen. So that's where we continue to go. And
How
again,
close?
this stuff is easy to see. Like it's very easy to knock them together.
I kind of like the question or scenario. I mean, how close do you think we are getting to like a yield curve control scenario? Of it's not clearly it's not today, but should this continue and sort of leak into many other Western democracies, governments aren't going to just sit there idle and say, well, it is what it is. Can they not just sort of stroke the pen, change policy willingly and just say, hey, banks are now allowed to hold, X number and you don't need to necessarily mark to market this security. Like, what kind of manipulations can be done there?
Well, they do all that. But I mean, first of all, I think everyone will agree that we already had that for a full decade.
Mm-hmm.
That
Right.
was
Yeah, that's what
yield
I'm
curve.
saying.
Yeah, when we have zero and near zero and negative rates in QE, and programs by central banks to buy bad assets for the banking system. That's yield curve control there. They've already done it. And now we finally start to escape from it. And what happens in the real world? It's kind of like remember the rattlesnake analogy? You're back away from it and Bigfoot grabs you. Steve still laughs at it. Rich doesn't laugh anymore.
Well, no, because I was
But
looking up something, but go ahead.
yeah, so we've already done it and we're definitely going back there again. But the great thing about this, we know what the response is going to be from central banks. And they're absolutely going to do QE again. If you want to call it money printing or something different, it's kind of irrelevant. But the Bank of Canada will always bail out the government bond market, because if not, the Canadian banks just collapse immediately. So they're going to do it. It's not a bad thing because we know that's there. It's the rest of the bond market you had to be worried about. And the Americans do the same thing. So will the ECB and the Brits and so forth. So it's again, the visibility is clear where we're going. You don't be afraid of it, but it's just the knock-on effects that people aren't really thinking about too much.
So, Steve, there's like a technical answer. So everything Keith said is right, but there's a mini technical answer that we have to throw in there, which is, so there's been like, they're basically the way that banks are regulated. It's like Basel 1, Basel 2, Basel 3 framework.
Mm-hmm. Mm-hmm.
And a high quality government bond, especially, I'll just read you what I read, especially from countries with strong credit rating. We can park whether or not those credit ratings are real or not, but just for the sake of argument, they receive something called a zero risk weight. And so there, people will start writing, well, if the French government bonds, which has a very high risk, credit rating, and probably has a zero risk weighting in terms of collateral and in terms of regulatory collateral that these other banks have to put on, that it doesn't affect that banking system via that channel. But the problem with that thinking is that it's nonlinear. And so, if I'm not mistaken, when Greece Greece, which was 2% of euro area GDP. So Greece's GDP was 2% of euro area GDP, and their debt was about 4% of euro area GDP. That's a tiny little country with a tiny fraction amount of debt. And their debt, if it didn't have a zero risk weighting, meaning there's no extra capital necessary to hold that debt on your bank balance sheet, when their bonds went from their 10-year bond went from basically 4 or 5 to 7 or 8 or whatever it was. I'm trying to quickly get the number. Yeah. So in 2009, it was 4.5%. And by the end of 2010, it was 11%. It caused a fucking meltdown basically in the European banking system. And so you have to think about Greece is tiny. Their debt as a percentage of GDP was tiny. Their risk weighting was probably relatively high, even though, obviously Greece has a shittier credit rating than other country. And yet it still caused all kinds of chaos. And so this is the problem. We have to get out of this idea that it's a linear thinking. Like if this one thing happens, then this equal and proportionate action will happen. That is not at all the case. And the other thing that's also really important is that it's kind of the problem with all kinds of bank runs or bond runs or any of these things of this nature. I'm not suggesting that this will happen, but the way you have to think about it is this way, which is it's a self-fulfilling prophecy. So we're already starting to see articles about the IMF bailing out the UK, bailing out France. Now we hit a 27-year high in the 30-year bond yield, a 15-year high in the OAT. So in the UK, it's called a gilt. In France, it's called an OAT. I don't know. I'm sure it's an acronym for something. I can't remember. But if we start to see a run on these long-term bonds, people are going to start to think, oh shit, these French banks are their bank. You know what I mean? So like, their collateral is not worth as much. And so, or whatever, or the risk weighting will have to be changed in order to maintain the Basel III framework, or maybe the credit rating will get downgraded or whatever. I mean, there's all kinds of little things that might happen that might precipitate people selling it even more and quicker and faster and more and quicker and faster. And so before you know it, a story that just 3 babbling turds are talking about on the podcast can snowball into a massive, not a bank run. I mean, I think France has, I think that they'll, like Keith said, they'll probably get bailed out by the ECB or whatever. But my point is that it can happen really quickly. And again, I wouldn't compare France with Greece, but my point is about how things that become almost non-issues overnight or within 6 months could topple a number of banks or a number of different companies.
A run on the French oats.
No. So hopefully Keith, I don't know if I did a good job in explaining that because we had talked about it earlier, but.
Yeah, it's a really good job. And it would be funny, like you're at the coffee shop this weekend and someone starts talking about the French oats. That's when you know, Steve, you've made a difference in the Canadian
culture. I gotta look up what that means.
3 babbling turds up north in Canada sparked a run on the French oats.
No. I wish we had that kind of power. That'd be amazing.
Well, I mean, I think that's a pretty good place to wrap it up. I mean, gold at 35.50 here. Keep an eye on that. I think it's telling us a lot. Up 35% year to date. The French oats, the UK gilts. There's a lot going on in the world, and I think probably a lot more to come as these central banks prep the cannons for more rate cuts and fiscal bazookas that are being prepped and aimed at all of us.
Another garbled military analogies.
That's what we're here for. So if you enjoyed any of that, we got lots more of it to come. As always, guys, appreciate the support. See you next week.